Bitcoin, Ethereum, Doge, Polkadot, XRP, and so on and so forth. There have been so many taxpayers that have capitalized off the cryptocurrency space in the year of 2020, and so many who are just now getting into the crypto space in 2021. My name is Carlton Dennis, and welcome back to Taxes Made Simple. In today's video, we'll be going over cryptocurrency taxes for beginners, so you have a better idea of what taxes you're going to be faced with. I've been getting DMs, messages, and tweets about Carlton, their Biden tax rates are increasing, and I'm unsure if my crypto profits are going to fall into that. So in this video, we're going to go over some questions that you might have around your crypto taxes, and if you wait till the end, I'll be giving you some strategies on how you can avoid the taxes associated with your gains. Let's dive in. In this video, we'll cover cryptocurrency taxes in a Q&A format. I have extracted 7 of the most common cryptocurrency questions that have been popping up on Google, Wikipedia, in my consultations, as well as my direct messages that I'm receiving from you guys on a daily basis. So what we're gonna do is we're gonna break down these questions step by step, very slowly, so we can understand how we're gonna be affected this year in 2021. All right, so let's go over question number 1. Carlton, if I made a gain in Bitcoin and pulled my profits out, but didn't cash out of my account, do I have to pay taxes? Whew. This is probably the most common question that comes up because many people realize that it might make sense for them to pull some of their profits. Maybe you pulled some profits out of Bitcoin, maybe you took some out of Ethereum, maybe one of these other ones, right? But you never actually exchange that money for US dollars and deposited it back into your account. So if it's still sitting inside of Robinhood or TD Ameritrade or one of these trading accounts that you might be able to use to buy Bitcoin, does that mean that you have to pay taxes? The answer is yes. And part of the reason why that you're subject to taxes when you decide to pull that money out but not exchange it for US dollars is because you made what's called a trade. And anytime you sell, that is a transaction subject to taxes. And it all depends on how long you've held on to that stock or to the Bitcoin that will determine how much taxes that you're going to be faced with. All right, let's jump into question number 2. Question number 2 says, Carlton, if I convert my Bitcoin to another coin, will I have to pay taxes on the exchange? This is another great question. Because sometimes rather than pulling your money, your profits, maybe you want to exchange for another coin. Maybe you want to go from Bitcoin to Ethereum. Let's just say that you had $50,000 in Bitcoin, and then after 2 months, you exchanged for $70,000 in Ethereum. When you decided to do the exchange, that is also considered a trade, and that's a taxable event. So if we went from 50,000 Bitcoin to 70,000 Ethereum, then we have a $20,000 taxable gain that we will be realizing, and we will have to pay taxes on it. So the answer to this question would be yes, there is taxable income when you do an exchange from one coin to another. All right, we're diving into question number 3 now. And hopefully these questions are starting to pique your interest and really are appealing to you. One of the questions that I just got is, Carlton, if my Bitcoin goes up and increases in value, do I pay taxes based on the increase in value? So let's talk about it. Let's say you're someone who got into Bitcoin early in 2020. Let's say you got in at $10,000. And let's say a month ago, now that we're here in 2021, Bitcoin's at $60,000. So you have a $50,000 increase, but you never sold, you never pulled your money out, you never transferred it. Are you gonna pay taxes on that gain? The answer is no. And the reason why the answer is no is because you never realized the gain. When you are realizing gains, you're deciding to sell. Even though the money may be still sitting in your account, that is considered a trade and you have realized gains. But if the money is grown and you're still in Bitcoin, you never sold the Bitcoin or traded it to US dollars, so it's still growing for you, then no, you have not realized any gains. So the answer would be no to this question. All right, let's jump into question number 4. Now that we're starting to understand realized gains versus unrealized gains, this next question will make a lot of sense. So this question right here says, Carlton, if I made gains and did pull out of the market, will I be taxed? Guys, the answer is yes on this one, in all cases. Now that we understand that pulling money out is a taxable event, we now need to understand what type of taxes are we going to be subject to. So there's two types of taxes that we have to understand when we are selling Bitcoin. There's either going to be a short-term capital gain, which means that we sold our Bitcoin for less than 365 days, or another type of coin or Ethereum, right? Or we're going to have a long-term gain, which means we're patient enough to hold on to our Bitcoin or Ethereum for longer than 365 days. Now, the government's going to incentivize you for being patient. They're going to give you more favorable tax rates. When you're looking at the more favorable tax rates of long-term capital gains, they're at a max 20%. And barely anyone pays that max 20% because it's really for those who are making over about $448,000. So typically we fall into the 0 or 15% tax rate long-term. However, a lot of individuals ended up pulling a majority of their profits this year, and they pulled their profits in less than 365 days. So if we pull our profits in less than 365 days, then we are going to be subject to what's called a short-term capital gains. Now, this gets thrown out a lot, and I really want you to understand what it means to be subject to short-term capital gains. Just telling you that you may be subject to federal and state taxes may not make sense to you. So I want to go in a little bit deeper to really analyze what federal taxes are. So let's talk about it.
Okay.
There are 7 federal tax brackets in the United States. Every single year they change due to inflation. There are federal tax brackets for single filers. There are tax brackets for when you decide to file married filing separate, if you happen to qualify as a widower, or if you happen to qualify as head of household. One thing that you have to understand about federal tax brackets is that just because your income says that you make $130,000 or $180,000 in profits doesn't mean that all of your money is going to be taxed at that 24 or 28% tax bracket. How the federal tax brackets work is that you have to fill up each bracket before you get taxed in the next one. And then, of course, you will also be subject to state taxes if you are in a state that taxes. So simply just saying, hey, Carlton, I think I fall into the 37% tax bracket, that may not be true. You have to make sure that you're factoring in the amount of money that's taxed into each percentage first before you truly know how much money you're actually going to be taxed on. So I just wanted to go over the difference between the long-term capital gains. We know that that's at 0, 15, and 20% maximum, right? And it's very rare that we see those that are over 20% unless you're profitable, greatly profitable, right? And then we know that we have short-term capital gains subject to federal and state taxes. And that's when we sell our stocks or sell our Bitcoin in less than 365 days. So the answer to this question is yes, you will pay taxes. All right, let's jump into question number 5. Now, there are some of my clients that are just getting into the crypto space. They realized that it made sense for them to park their money outside of their bank account, so they moved money over to the crypto. But then I have some clients that have believed in crypto going back to 2016 and 2017. They're sitting on major profits. They're sitting on so many profits to the point where they're starting to lend out their crypto. So let's go over question number 5. Carlton, if I'm lending out my crypto, will I be subject to taxes? Well, if you're lending out money, which is a function of crypto that you can do, I would consider it an advanced function of crypto, then the type of money that you are receiving on the back end is going to be considered interest income. So just like any other type of interest that you might receive from having money sitting in the bank, you're going to receive the 1099-B form. A 1099-B form reports your interest income to the government, and it's the form that you need to file inside of your tax returns so you can pay taxes. So the answer would be yes. The interest income that you receive, you will pay taxes on, but the principal, the money that you're lending out, you will not pay taxes on. All right, let's jump into question number 6. Carlton, can I reinvest my crypto gains to avoid taxes? This is a popular question as well, and it's a good question to ask a tax strategist like me, because before you decide to reinvest your gains into like another cryptocurrency or into something else, right? We have to figure out, is that something that we can do to avoid taxes? Well, the IRS has made it very clear, because they're now starting to crack down on crypto, that any type of exchanges cannot exist in the crypto space right now.
Say what?
Now, you might be familiar with other exchanges, such as real estate, the 1031 exchange, where if you have a gain on your property, you can sell the property, avoid taxes by leveraging a 1031 exchange, buying another property and then rolling over your proceeds and cost basis into this other asset that you just purchased. However, in the crypto space, the IRS has made it extremely clear that we cannot do any of these types of exchanges. So if you are planning on exchanging your crypto, it will be considered a taxable event. You won't be able to exchange to avoid taxes. So just be very careful and mindful of any time you decide to sell. All right, let's jump into question number 7. Carlton, will my cryptocurrency account send me an IRS form at the end of the year like my TD Ameritrade account does? Okay, that's a pretty good question. So the answer is yes. If your company that you're using to trade crypto on is in compliance with IRS reporting and regulations, as it should be, so you should be very careful about which platforms you're using to trade on, then this company should be sending you out a 1099-B form at the end of the year, just like your TD Ameritrade account or any other brokerage account that you might have. When you receive this form, it will show all of your transaction reports and all your transaction history, because that company has to report all of your trades and all of your transactions. So you should get a form at the end of the year reporting your gains or reporting your losses, so you can go ahead and file that inside of your tax return. Now, let's discuss some strategies that we can leverage to reduce our taxes with the cryptocurrency profits that we've obtained. Let's dive in. The easiest strategy that I can give you starting out would be not to sell your cryptocurrency gains. And part of the reason why is because many investors who are true investors are getting into the crypto space to hold on to their investments. I mean, I've seen so many of those different tweets and different monograms of if you would have put this amount of money back into crypto 3 or 4 or 5 years ago, what would have happened, right?
You're right.
So what would happen if you just held on to your cryptocurrency and didn't sell it? Well, we know for a fact that you wouldn't be subject to the short-term capital gains, and you wouldn't have to face the long-term capital gains just yet. So a lot of my clients are holding on to their cryptocurrency and not taking on profits, and they're taking out loans against their cryptocurrency.
What?
See, when you decide to take out a loan against your cryptocurrency, that is considered a non-taxable event. Just like borrowing from your own house and cash out refinancing, or taking on a loan from the bank. Anytime you're doing this, the money that you receive is not considered taxable income. This money can be parlayed into additional investing, can be used to go buy additional Bitcoin, or really do anything that you would like to do with it. So one of the items that a lot of my clients are doing is rather than selling their profits, they're choosing to loan against their Bitcoin. Strategy number 2, self-directed investing in a Roth solo 401k. Now, you may be familiar with a traditional solo 401k, but part of the reason why I'm recommending a Roth self-directed solo 401k is I do work with a lot of self-employed individuals. And as a self-employed individual, you get the ability to set up your own retirement account. So you could set up a retirement account through an LLC, an S corporation, a C corporation. And instead of contributing to a tax-advantaged retirement account that you get to avoid taxes on right now, such as a solo 401k that you can contribute up to $19,500 and receive a tax deduction for, you can implement a Roth self-directed solo 401k. So you do pay the taxes now based on your contributions, but then the money that you're investing into the Roth actually gets to grow tax advantaged. And the beautiful part about having a Roth self-directed solo 401k is you get to contribute far more than a traditional Roth IRA. And since it's a self-directed retirement account, you have control as the taxpayer over what you wish to invest those dollars in. So let's just say you were someone who had this Roth self-directed solo 401k and you had a business and you decided that you wanted to invest those retirement dollars into Bitcoin or Ethereum or XRP. Well, since it's a self-directed account, you have the control over what you wish to invest in. And as long as those investments are sitting inside that account, it will grow tax advantage just how the Roth is supposed to. So that is something that you might want to take into consideration with your tax strategist to see if it might make sense to implement a Roth self-directed solo 401k for your investing. And strategy number 3, using losses to offset your taxable income. This is one that I harp on a lot with my clients in the office because many of my clients don't take into consideration losses. You see, losses have the ability to offset taxable income. So rather than not taking advantage of your losses and not remembering that you could use your losses, I do want you to become a little bit more savvy as an investor. And I also want you to think about what stocks you might consider selling with your financial advisor, or if you know how to manage your finances yourself, so you might have some losses to offset your taxable income. Now, another strategy that we leverage in my office is qualifying as a real estate professional. Real estate professionals are those who are able to utilize their active losses to offset all versions of income, putting them in a better position to avoid taxes and possibly even become 100% tax-free. And if you like this video, what I'd like for you to do is feel free to like, comment, subscribe so I can continue to make more videos like this for you. Also, if you're interested, I will be creating a tax strategy course for real estate investors who are looking to leverage real estate professional status to reduce your taxable income. Feel free to visit the link below to sign up for my waitlist to the Tax Alchemy Real Estate Strategy course to learn more.